Hlelo, let's start off by looking at what's been happening on the equity front, over the last few weeks. It's been quite interesting to see everything play out. And we've got the Dow Jones at around 9,686 points. So at the end of the day, we're below that key 10,000 level. We're seeing weak unemployment data coming through. And of course, we've also got a lot of pressure from the sovereign debt perspective in Europe. What has your sense been of the market so far?
I think times are really difficult. And I think that people should do two things in parallel. Think about the stock market on the one hand, think about the economy on the other hand. I think that the world, from an economic standpoint, is really wondering which is the best way to heal the world. Is it to spend your way out of trouble, like the US model says, just keep on racking up huge deficits, or do what the Europeans want to do, which is cut spending, cut enough spending and clothe yourself according to your cloth, and then work your way out of it slowly. I'm not sure which one will win, but in Europe, with slow spending, it's going to be very, very slow growth. With the United States, if they continue spending, they're going to be high interest rates and high yields, and the government may not be able to finance itself in the future. Now, on the stock market, people are looking at this and saying, well, what's priced in? And we know that what is priced in is not the minimum earnings power for shares. In other words, shares aren't really saying that things are going to be terrible. Shares are not really that cheap yet either. They're just average.
Something interesting I noticed last week was the dollar was weakening against the euro. We've got the euro sitting at 125, still sitting at that level. And that was despite not any good news coming out for Europe last week. In fact, we had Moody's threatening to downgrade Spain's ratings. Do you think investors are starting to recognize the debt position that the United States is in, the fact that it's not taking any measures to cut its deficits, and we had all of that negative economic data out of the United States last week that show that that economy is not recovering very fast?
That really is at the crux of what's happening in the market. That investors are wondering when they'll have to increase the interest rate at which they lend money to the United States. And the United States almost has a stay of execution. They'll get hit at some point, probably next year. For now, Europe is getting hit. Spain is the next one after Greece. It looks like things are going to be terrible for Spain. Now, the US has said, we're not going to cut our spending. We need to spend our way out of this trouble. Now the market is saying, is it really possible that one day the United States could actually fail to pay us or devalue the currency in order to pay us money? Well, we'll never know until that day comes. But in the meantime, you can see interest rates in the United States are actually going down. So the yield, the 10-year yield, is actually going down from 3.9 to 2.9 now, just in a space of a few months. But the dollar is also weakening. So you can see, there are a lot of mixed signals, but the United States is not in as unassailable a position as it used to be.
Don't you think it's just afraid of a double dip scenario? That is why they still want spending in place, and that this is what they're warning Europe about, saying, yes, it's great that Germany is cutting back on spending with 80 billion euros, but at the end of the day, austerity versus growth versus double dip, I mean, these are the big issues that have come to the fore. So you've got to find a good balance.
Right. But the point is, you can get into double dip either way. In both scenarios, you can get into double dip. Now, let me give you an example. We had a stimulus last year of $800 billion that the US government put out. Okay, European governments also put out a stimulus. Now you can see a year later that the stimulus impact has faded. The private sector hasn't jumped in. It cannot be that the government keeps stimulating and no one else comes in to give the stimulation traction. If the private sector doesn't come in and banks don't lend and companies don't borrow to put their productive assets to great use and to hire unemployed people who are very skilled, if that doesn't happen, you can spend all you want as a government, you'll probably just become less credit worthy, and the economy will fall off a cliff and you'll go into a double dip recession.
Does that come down to the underlying demand factor that we've been seeing from the consumer? Because the private sector can only really step in once that demand factor actually picks up on the ground, surely.
Now, who's a private sector? The private sector is financial institutions, banks, and non-financial institutions, manufacturers, miners, and pharmaceuticals, and so on and so forth. The honest truth of the matter is, nothing happens until the bank loans people money, so that they take the money, they oil the economy, and they produce stuff. Banks aren't lending. You have to ask a question: why aren't banks lending? At the same time, the non-financial institutions are sitting with a lot of cash on their balance sheets. They are also not spending. Why? It's a confidence problem. I think the United States has to, and not just the United States, Europe also has to induce confidence of the economy I think there are just some things that they need to do well. One of them is financial reform, not of banks, but of the government itself. You know, simplify your tax structures, give investment incentives to certain industries. So do a few things well enough to bring back the confidence. Otherwise, you're like Japan. You can suffer deflation going forward for the next few years or for many, many years to come. And I think that's why businesses are not spending. If you're going to spend something, manufacture it, and then sell it at an increasingly lower price because there's deflation. Who wants to do that?